All right, today we're peeling back the layers on the economy, looking past all the noise to see what's really going on. Let's dive in. This quote just hits the nail on the head for where we are right now. It feels like we're all trying to navigate through this thick fog of mixed signals and, frankly, missing data. And in the middle of all that confusion, huge decisions are being made. So for weeks, the US economy has kind of felt like a ghost ship, right? Some of the key economic data we rely on was delayed, which meant the whole story was being driven by pure speculation. But right in the middle of all that noise, the Fed stepped in and made a move with very real consequences. Okay, so to really get what that move means, we have to talk about what the Fed actually does. And spoiler alert, it's probably not what most people think. You see, the Fed doesn't just tweak an interest rate. They are, for all intents and purposes, setting the price of time itself. This one number, it ripples out and affects literally everything. The rate on your mortgage, what a company pays to borrow money, even the return you'd expect from a safe government bond. So here's what happened. On December 10th, 2025, the Fed went ahead and cut rates, setting the new target range between 3.50% and 3.75%. But honestly, the cut itself, that wasn't the big story. The real story was the message they sent along with it. The Fed is walking this incredibly fine line here. They're trying to cool down inflation without completely torpedoing the job market. So their message was really, really carefully worded. They said they'll weigh the extent and timing of future moves, which, that's classic central bank speak for, hey, we're cutting, but don't you dare assume we're on autopilot. But then we got the detail that the markets just can't ignore. And it really pulls back the curtain on how tricky this whole balancing act truly is. The vote, it was 9-3. That's not a consensus, folks. That shows a divided committee. They weren't all on the same page. They were all staring down the same core fears, just from completely different angles. And this really lays out the two competing nightmares they're dealing with. On one hand, you've got people on the committee who are worried the economy is going to cool down way too fast, maybe even tip into a nasty recession. But on the other hand, you've got members who are terrified that inflation is going to roar back to life and undo all the painful progress we've made. The fact that there were 3 dissenters, that tells you just how real both of those risks feel to the people in the room. Okay, now there was this quieter detail in the announcement that's actually pretty important. They mentioned keeping bank reserve balances ample. Now, if you see that, you might think, oh, that's stimulus. But it's not. It's really just plumbing. It's the Fed making sure the financial system has enough grease in the gears so the money markets don't freeze up, especially not right when they're trying to change direction. It's a technical fix, not some big philosophical shift. So, in the week after the Fed made their move, a bunch of economic signals started trickling in. And they began to paint a much clearer picture of what's happening out there. So let's actually look at what that data told us. So when the hard data goes dark, what gets loud? Well, narratives, of course. Stories. With some of those key government reports delayed, the market was basically flying blind. It was getting bits and pieces of new information, but with huge gaps in the picture. And all this was happening while the Fed was screaming from the rooftops, stop making assumptions. I mean, it was a perfect recipe for volatility. All right, so let's walk through the key pieces of data that really shaped the story that week. We'll start with housing. Okay, so homebuilder sentiment, it ticked up a little to 39, but here's the thing. Anything under 50 means that overall, builders still see conditions as more bad than good. It just shows you how much those higher interest rates are still weighing on the market. Builders are having to offer incentive just to get deals done, which tells you we're looking at stabilization, not another boom. Next up, let's zoom out a bit to the wider economy. On December 16th, we got an early look at business activity, and it had cooled to its slowest pace in 6 months. So yeah, the economy's still expanding, but it's definitely losing steam. And that combo of slowing demand while costs are still high, that is an uncomfortable place to be. And it's exactly why the Fed isn't promising a simple, easy path of rate cuts. So what about the consumer? Are people still spending? Well, on that same day, the retail sales report came in, and it was basically flat. Not a collapse, not a boom, just cautious. And a flat number like that actually matters a whole lot more than you'd think, because inflation really starts to cool off when you, the consumer, become picky. The moment households start to hesitate, businesses lose their power to just hike up prices. Then we got the weekly jobless claims. They fell to 224,000, which historically is still a pretty low number. But here's the crucial part. Jobless claims only tell you about people getting laid off. They say nothing about hiring. And right now, all the signs point to hiring slowing way down, which means the labor market is definitely losing some of its strength. And what about manufacturing? The Philly Fed's factory survey? Well, it sank even deeper into negative territory. Now look, that survey isn't the entire U.S. economy, but it's often a really good indicator of where things are heading, a real live wire for turning points. And this has that classic late cycle feel to it. You know, a weak headline number with a really mixed and confusing picture underneath. So we've got all these different puzzle pieces, right? Housing, consumers, the job market, manufacturing. What does it all look like when you put them together? What's the real story here? Well, here's the bottom line. The Fed cut rates, but it also told the markets to cool it with the daydreams of a long, rapid series of cuts. Housing seems to be finding its footing, but it's being propped up by incentives. Consumers are still out there spending, but they're getting a lot more selective. Business activity is slowing down. And yeah, layoffs are still low, but the labor market just doesn't have the same amount of oxygen it used to. So the big question is, where do we go from here? Well, this next phase isn't about hoping for the best. It's all about confirmation. We really need to watch and see what the incoming data actually confirms in the next few weeks. As we look ahead into 2026, there are really three main paths this could take. Path one, that's your soft landing. For that to happen, we need to see inflation keep cooling off, but without a big spike in unemployment. Path two is what happens if the labor market really starts to break. If we see jobless claims start shooting up, the Fed will be forced to move fast. And path three, well, that's the toughest one. That's where we end up if inflation gets stuck while the economy keeps slowing down. That means some really uncomfortable choices. You know, at the end of the day, the Fed's job isn't really about predicting the future. It's about preventing the worst versions of it from happening. And for all of us trying to make sense of this, the key is to tune out all the loud, dramatic stories and just focus on the data itself. In a world full of loud broadcasters, you really have to learn to trust the quiet signals. And just a quick reminder for everyone, this is purely for educational purposes. It is definitely not personalized financial advice.